But if you do,
Wednesday, November
we're going to
16th,
give you money and a
2022.
place to
This is our
stay, then
regular
the
presentation.
first part doesn't matter. It's like,
All
I
right, here
have a
we are,
friend
man.
who's always
Fourth
going on
quarter,
and on to you, like, oh, my
second,
ex won't leave me
third
alone.
of the
Like, he's
quarter.
texting me all
So
the
we're on our
time. He won't leave me
second
alone. Oh my God, he's so annoying.
4-week
But she
cycle.
leaves
We
out
have
the
3
fact every time
4-week
she gets drunk,
cycles.
she's sleeping with.
We're winding down pretty quick. We are 45 days behind us and 45 days till New Year's Eve. That's it. It's going to be a wrap. So you're halfway, man. And really more than halfway because of the holidays. So this is what we're looking at. First month of the quarter done. And we're sitting here today on November 16th. This is behind us. This is behind us. And for most of you, this is probably going to be the end of your week. So you got a couple of days here and first part of the week. And then we're going to be heading to Christmas. We'll be together here and here, here and here. And then it's probably going to be the end of it. For most people, if you have kids, you have young children, or if you're big on Christmas, that's going to be the end of it. And then the first week in January, you're going to obviously miss out until we get back going and you're done with the holidays, kids go back to school or whatever. So that's it. That's going to be the year. That's a wrap. So you still have some time to get something done. You can set up a new trade plan, work on your entries. The markets are still going to do what they're going to do. In fact, the week in here going into New Year's Eve is pretty aggressive, especially in the stock market. But you'll see some setups. I remember someone sent me a setup, I don't know, several years back now, but like on the 22nd, the last day, there was a perfect W formation, I think at GBP or Euro. But anyway, the things are still going to be there. The volume's a little lighter, but if you're trading normal size, it's not going to matter. You're going to get filled, especially in Forex. Markets are heavy always. All right, so that's where you're sitting. 12-week year. This is how you start planning for next year. Okay, you should be using this all along. If you're brand new, get a hold of this book. I don't want you to physically read the book. I want you to get the audio version of it and just listen to it, make some notes, and we're going to talk about this book, how to start mapping and get yourself set up for the first quarter of next year. It'll probably be my first or second presentation of the year. All right, so we were doing some pop quizzes. We talked last week about how do you know which way to go, and we talked about leaning on stuff, developing a directional bias based on what's going on in the charts. I talked about how the 1 minute should be used for entry or the 5 minute for entry. And that's it. No pop quiz tonight. This was the pop quiz a lot of time, but it reminded me, remember, 1 and 5, 15 for directional, 1 hour for directional. So this should be your directional bias. This should be your monitoring for stop hunts and patterns, and this should be your entry. So it's entry, monitor, bias. Does that make sense? Okay. All right. So I mentioned to you last week that I showed an aggregate entry model just basically, and a couple of people took my advice and they added the extra orders or order to their entries and they got better. Okay, so what's the question you should be asking yourself if you're not sure if this is for you? Okay, this is it. How many times during the week or the course of a trading week do you say to yourself, man, I should be getting in now, I got in a little bit too early? Or man, I was a little bit quick on that one, I probably should have got in on the close of this candle. If you find yourself saying that regularly to your screen or to yourself or to your wife or whoever, if you're saying that, then listen up, man, this model's for you. An aggregate entry model is going to space out your orders a little bit, right? It's going to take a lot of grief out of trading and getting stopped, right? So pay attention, stop all your trade grief by the time this lesson is over. This works on trying to get qualified for prop accounts, as well as actually trading prop accounts, right? The key is to spread out your risk through spacing and time, right? What happens if you get really good and only one level gets triggered most of the time? Then you graduate to all in, all out on one entry. The way to check that is to take the trades you took and see what got triggered and what didn't. And out of the ones that got triggered, here's the thing, if the second order is getting picked up, that is where the stop should have been. So if your second order is getting picked up more often than not, you still would have been getting stopped. If your second order is not getting picked up, then that would have been a regular trade with all in, all out, right? Because if you have your first order here and your second order here at the stop level, right? This should have been the stop level. So if you're getting in here and it's doing that, going in your favor, or if you're getting here, it's picking that up and then doing that, then this was a stop out. So go back through the sheet or your trade stats and see where you're at. Okay. Eventually, you're going to want this second order to get triggered. You want it to get triggered initially, because then what's happening is you're getting a good aggregate entry, right? So if you're trading even size and this is 10 pips apart, then you're 5 pips lower on this entry and 5 pips higher on that entry, because on aggregate, you're in the middle. Okay. All right. The concept is to vary the entries over time or price to build a manageable order book of your own. So the way it was put to me years ago was the dealers vary the levels. Why wouldn't you? They don't hit the stops exactly the same every day. They don't print the pattern exactly the same every day. So if they're spacing their orders to unload the book, then why wouldn't you space your orders to manage your side of the book, right? It truly is the last step to trading like a dealer. But the idea obviously is to be an all in, all out, because we don't have that kind of money to trade at the level they're trading. Right? So market conditions vary. So this approach allows for less stop triggers, more winning trades, and a more stress-free approach to trading. Works better with more money, right? No kidding, doesn't everything? Okay, but getting qualified gives you the opportunity that I never had. You can qualify for 200,000, and if I'm not mistaken, you can have a couple of accounts, and you can, I think if you roll over a couple times, you can grow your account up to 7 figures. So if you're trading a 7-figure account, you absolutely have to pay attention to this, because now your stops are going to cost you 5 grand, 10 grand, 15 grand, depending on how you're going. So the last thing you want to do is not get stopped. So less stop outs equal more money in your pocket at the end of the month. And I mentioned you a couple weeks ago, and I talked about this. I had to trade my way to this number to be able to afford to do this. And it was 200,000 or 250,000 was the number I put up. It's different now, man. I'm telling you, there's more stress putting out your own money versus qualifying for a fee, a small percentage to leverage that kind of account size. So whatever their rules are, right? We already know we have validation from people getting checks in the group. They've posted, they've talked about it, and I have firsthand knowledge that they're getting paid. Okay, so we're using borrowed credibility. These guys are getting it done. So that means you can get it done. Okay? It's borrowed courage, borrowed credibility, whatever you want to call it. All right. So now, what does an aggregate look like? Okay, well, you know you have multiple zones, right? We split this area on the chart right here in half, right? This is no go. If you remember, this is no go side, right? It means you're not supposed to be taking a trade. And this is go. All right, so how would you get your entry on? All right, well, you're gonna draw some conclusions from the levels that we've been talking about, right? You're gonna draw your boxes on these levels when price pulls away, and you're gonna build some type of scalable entry system. You can use a 2-entry model, a 3-entry model. It depends on what works for you. If you're, I don't know how to say that, if you're having a lot of problems, I was gonna say if you're sucking really bad, but that's not very polite. If you're struggling, all right, more than you think you should, then I want you to start off with a 3-entry model. Okay, let's just say for argument's sake, you're trading 6 minis in this model, right, to get one lot off. So you would do 2, 2, and 2. That's how you would space your orders, and that's how you would place them. All right, so in this example, you're looking for distance from here to here and from here to the low swing. You want it to be somewhat equal, right? And if this order actually falls outside of the realm of this box, that's okay, because a lot of times they sweep through and pull back. We know that. So let's just say for argument, this is 10, they're 10 pips apart, 10 pips apart spacing, right? That would give you a 30 pip swing variance and then 10 pips below that. So you basically have a 40 pip swing that you can catch the low swing of the day on. Listen, I'm going to be straight. If you can't catch the low of the day within 40 pips, you're in the wrong business. You need to talk to me. You need to, I don't know, dog ate your homework, something happened. All right. If you have a 40 pip variance to catch that low swing and you're getting stopped out, then you're either starting way too early or you're not seeing clearly. All right. A lot of times the third order doesn't get picked up, and the way to do that would be to cancel it. And when you have these two orders working and get your stop out in front, then you would probably add that order on in here. So you can get the benefit of all three orders, which would be some number. Let's just say you're risking 2% on two minis. That would be 2, 2, and 2. So you want to get the full risk on. But the thing is, if these orders are in profit and you got to stop in between them or up, then you're only going to be risking at this point in time, you're going to be risking 2 to 4%. Because if you caught the low swing, then that order should be blocked. Once that margin and that order is blocked, then you're only going to have 4% on the table. The idea is to manage risk and orders in such a way that you get stopped very little and you give yourself a chance to go for the higher swings. Right? This could be a good target, or the full run today could be a good target on this particular one. So basically, you're using, just like the dealer, time and price to space your orders in order to get a more acceptable entry without getting stopped. Less stop outs means the more profit you keep at the end, taking away the fear and anxiety, right? Once you get multiple orders on, there's a break-even point between 2 orders or 3 orders. Okay, I used 3 orders initially, and then I got better 2, and then I stopped doing it. And that's the goal. The goal is to start with 3 orders and find out some number of risk you can use, get down to 2, and then become an all in, all out. And there's some people that have traded this for years. They liked it, it worked for them, and they had a larger size account. And they found success doing that. All right, so I was going to tell you to mark it up, but I just want to do it for you. I want to just walk you through it. So let's just say in this M example, right? Here's the M. You got the first couple legs going in. Let's just say for argument, 3, 2, 1. Price was moving up. You get the pullback here. Here's your apex nadir, right? You're looking to start selling as price approaches here. So you'd sell here, maybe here, right? And maybe here. The spacing between here needs to be, here's the thing. Don't take multiple orders on one bar unless you know it's the reversal bar and you have a wick or something developing and then it's coming out of there hard. It doesn't happen often enough. You use time and price in your favor. There's no rush to get in, right? And some people use, and I think Peter over in Switzerland or Sweden still uses, we used to call it a foot soldier, right? That was your FS entry, was a foot soldier, which is a small fraction of your overall size. So he would do like maybe one lot. And then when he found his spot and to see how it was going to play out, then he would scale in with 4 or 5 more lots on the back end. He would have a total of 5 lots on. His risk would be less on the front or the first touch. It's a funny thing, man. When people put an actual order on, it changes their level of excitement and commitment to what's going on. And then in some instances, they could start seeing more clearly. Like explaining the foot soldier is like, okay, man, I'm just sitting here watching candles right now. I throw an order on and my money's on the table. All of a sudden, I'm kind of more paying attention. And I see, man, look at that. I should have got in there. But the good news, he only got in with a foot soldier, which is 25% or 20% of his total order float. Right? So he was using the model where he would get in with a foot soldier to see if he had the right directional bias and things were going in his favor. So if he stopped out, it was only 20% of his position. So if that stopped him out or he didn't like the way it was going, then he would just take the hit on the one lot. And how do you do that? Okay, so if you're waiting and let's say you decide to go in here, let me erase this for clarity. Let's say you decide to go in right here with a foot soldier. Okay, what your plan is to catch this turn bar. Okay, well, we know this is the zone right here, right? And actually it's into this wick, be a little fairer, right? That wick and these two tops of these 2 bars, that's the zone. Okay, so if price comes through here and does this, right? We know that's no go. So now he has a chance when price breaks to add his last order on here and on this pullback come out and profit. And if he's using 1 to 4, right, you do some basic math on that, it's only about a 25% pullback, which is basically a few ticks to cancel out one order, right? Think about this. If you have a 10 pip spread, okay, and this order's on at 10 and it goes all the way down 10 pips, where do you have to do? If you go one here and one here, you got to get 5 pips to be even, right? Okay, if this is 2, that cuts it down to 2.5 pips to be even, plus the spread, of course, right? So if it's 3, it comes in right around 2 pips, which will put you slightly above even. 2 times 3 is 6, so 1 tick is 6, canceling out, what would it be? So 1 tick would be 9, right? So it would be maybe a little bit more. So if you go, what would it be? 3 times 3 is 9, so 4 ticks would put him in profit. 4 ticks would be a 6 and a 9, and he'd be plus 3. You take that off, cover the spread. See what I'm saying on that? So your first entry is 0, and then your second entry is some variance from there. Your spacing, to be fair, your spacing should be at least at a minimum of 10 pips and should be at least 1 to 2 candle separation. That's how this is done. You don't get in on the same candle. Okay, you do not get in on the same candle. So you're trying to vary the candles, which is variance of time, and you're trying to vary the price, which gives you a better aggregate entry. I like to use evens. Okay, there's spacing that you need to be concerned about, which is in the go zone, you're looking maybe to be going on the rising bar and the falling bars, right? But you always want to try to catch the turn. The idea is, if you're going with your foot soldier here, then you want to try to wait for the railroad tracks or something to give you the turn. That would be your next entry, and then this could be your next entry. So you had a 5-minute chart or 15-minute chart, 1, 2, 3, 45 minutes, 1, another 15. So you had timing and price. So it took you about an hour to build your position, and you varied the level in 3 occasions. You have spacing. That would be a good successful run. Okay, if you're not trading this tight M here, then this would be the cut, right? This would be the go zone. And you would do the same thing. You would space this out like this, right? And this. Then this becomes your go, no go. So now you're on the go side. So maybe when price starts moving down towards your favor, and maybe this psychs you out and you think this is a good railroad track, and you sell one there. Price goes up, right? All of a sudden it closed above. You see intentions of going higher. Now this is the next level. If they break this level, then you got a problem. But it rejects it and closes on a hammer, you're going in on the close of the hammer. That's 2 orders over 5, 10, 15, 20 minutes. Right? Now they shift and they give you a little pullback. You like it, you take your last order. So now you have time and price spacing, and you have a nice order built out. Then you let this thing run. The thing that's neat about this is break even on 3 orders is the middle order plus 1, right? If you have 3 orders like this, break even is this order. Let's just say we're going up. Break even is this order plus 1. Okay, it's actually this order, but you got to cover the cost. So within a, if you're using 10 pip spacing, within a 6 or 7 pip spacing, you're even. But remember, this varied by up to 20 pips. All right, so if this is 10, this would be 11, and you're out. If this whole thing is 10, it would be 6. Depends on how you're going to build it out. Everybody's different. So if you want to work up a model and send it to me, we'll talk about it. There's a lot of power in this. Because like I said, you can do a foot soldier, or you could do all evens. So if you're trading 6s, you would go in over here with 2, 2, and 2, and that gives you the full build out of your orders. And then break even is going to come somewhere in this range, and when price starts moving in your favor, you'll see it. Now, I talked about spacing weighted versus evens. Weighted is light on the beginning, like you might use a 1, 2, 3 order. So what'll happen is, right, this is going to cancel this and this out a lot faster than if you just do 2, 2, 2 or 1, 2. But the thing that I liked was that a lot of times I was getting this and this on, and I wasn't having any luck, and this was sitting. This is the best order. So I decided if I was going to do it, right, you could do 3 and 3, right, because you're doing 3, 4, 5, 6. So if you're doing 6 orders total, then do a 3 and 3 with a little more spacing and try to get both orders on. And then you can get orders on the way up and then maybe on a break. So if you only got one order on here, then you get that final push that guarantees you're in the right place. Then you add the other order in there, right? Same thing inverted, right? You're trying to get in somewhere around here. And if it gets away from you, starts going, then maybe you put the other order on here. It's an easy thing to do. And if you're using a $200,000 account with a 2 to 3% risk, calculate the money, how much room you got for spacing and stop outs, and you're going to be in a good place. And ironically, I've always been opposed to over risking or over leveraging, but you can risk a little bit more because you're going to have less stop outs. So your drawdown is going to be minimal. The actual, you're going to have an open float draw versus a realized draw. Okay, so what does that mean? So if you take this order and it's running against you, right? Let's just say this ended up being the top, and you take this order down here, this is running against you. You're only a few ticks away from triggering your second order, and then this is going to put you in a few ticks back into profit. So your open float draw would be, if you're ticking $300 a tick, right? 10 ticks is going to be negative draw of $3,000, but I think that's manageable on a $200,000 account, right? I don't know what the rules are, but it certainly is. And then you're going to trigger the second order, and if you finally caught the high swing here into the pullback, you're going to be in profit, right? If this is 10 ticks on tick 6, you're going to be even, right? And if you can't get a 10 tick bounce your way to get clear of both of these orders, get the stop out in front, then you definitely need a third order, and that would break those down into 10s, or you need to practice some more. I promise you, if you're struggling in any way, shape, or form, this is the answer. If you can't catch a low swing or a high swing, and that comes from not doing the high-low drill, by the way. If you can't catch a low swing or high swing, it's because you won't do the drills. Or if you've done them, you haven't sent them to me, right? But the goal is to buy or sell the stop loss level again, because, right, we know the dealers come in aggressive, pull back, and hit it again. So if you're in somewhere in here and they trigger the stop, you should have an order sitting there. Like, let's say this is your entry, and instead of putting a stop loss order here, right, instead of a stop loss, you're putting a limit to buy, right? An LBO, limit to buy order. Okay, so if your stops have been typically 20 pips, okay, so then you put a 20 pip distance away, secondary order, even with the first. So if you went 10 lots here, then you go 10 lots here, 20 pips lower. Or if you know they trigger the stops at the very edge and they're heading down that way, then you put a 20 pip order, and then you need a stop 10 pips below that. You have to stop the structure if you're dead wrong. Okay, and that's a hard thing to do when you got two big contracts floating, right? And with spacing, because the first order might be down big, the second order is gonna be down a little, and you're hoping to get the turn. But more often than not, you'll get the turn in your favor, and it's enough to give you a scratch, right? Instead of a stop out. If you took this trade, all right, let's talk about that. If you took this trade, right, and you got in when it was coming down here, and your stop loss was here, which means you had a secondary entry, right, off of the zones you drew. Okay, so now instead of being stopped out, you're hot. Okay, if the stop has to go somewhere, it's got to go here. So your draw, max draw, is going to be the distance from here to here and the distance from here to here on both orders. You got to calculate that. But a lot of times you would have been stopped here, but you're still hot. When price starts coming up, if you could start looking for a place to ditch, if you feel like it was one of those break belows, come back above to continue lower, right? Remember I talked about how they give you the retracement? That little retracement is all the window you need. And as soon as you see your entry turn green in your favor, if you're uncertain, scratch the whole structure, kill it. So what I'm saying is if you get a couple of ticks slightly above, 60% above, right? If it's 10 ticks, if the spacing's 10 ticks, if you see 6 or 7 ticks, take the hit, close it. You have to play with it and get a feel for it. I recommend doing it in demo, and I recommend giving it a fair chance to work because it's amazing. All right, and it's a really cool way to trade. It'll squash a lot of your fears of getting stopped out because it doesn't exist anymore. You're going to become very accurate because the structure is going to save you in your mistakes. The idea is not to get sloppier, but to become more accurate and seeing things more clearly. And putting a smaller order on weighted, which I'm not a fan of, using a foot soldier and then getting your full order on, that's okay too, because it'll make you pay attention better and start paying attention to what's going on. And you'll start to mature as a trader. Things will change for you. I'm certain of it. It's a really powerful tool. All right, so what happens when the second order is triggered? All right, you have to adjust your limit order. Okay, so here's the structure we're building out, right? Let's say our limit is 50. All right, let's say you got it all the way down and you use a 20 pip spacing and you got in here. Okay, well, if the low swing was 20 pip lower than your initial intention, you need to subtract this down to 30. You're still going to get 50 on the second order, and you're going to get 50 minus the spread, right? This order is 20 pips lower. 20 plus 30 is 50. This order is 20 pips higher. So you're going to get 30 and 50 on both orders. That's 80 ticks, right? On two orders, depending on the amount, right? It could be 8,000, 800, whatever. Just keep adding zeros, man. It could be 800,000. Depends on what you're trading. But when it gets triggered, so you adjust your limit order to the initial target minus the second limit value, right? So if your limit value went here and the spacing is 10, then you only pull this back to 40. That's your new limit order to get out. You adjust your limit by the spacing of the triggered. Does that make any sense? Adjust your limit order to the initial target minus the second limit value distance becomes your new limit order. All right. It's a mouthful, but it doesn't matter. Okay, if your limit is 50 and two orders are triggered, and you have to adjust your limit order to the distance that this was triggered at. If you're using 10, it comes down to 40. If you're using 20, it comes down to 30. You slide this back. So one order comes out at 50 plus 50, one order comes out at plus 30. The higher order comes out at the same place. You close the whole structure flat. And that's what Heidi Close All is for. She'll flatten the hell out of your account quick. You put that on there, bam, anywhere globally. So make sure you have global variables enabled and you check all the boxes inside EAs and auto trading. Make sure all that stuff's triggered. Try all the stuff in demo, man. Demo, please, until you get it right, and then try to get qualified with it. Okay, now, what do you do when price goes to break even? Same thing. You got to cover both orders. So adjust the stop to midline plus 1. Talked about that. So I'm just going to use 10 for it's easy for me to do the math, and you guys know how I roll. All right. Order 1 is here. Order 2 is here. Stop level is here. And I'm just giving you a 2-order model. Just figure out the math for the rest. Okay, so where's break even in this structure? If you're trading evens, price comes down and triggers this order and this order. Okay, well, let's count the whole structures. Let's say stop loss is below here. Okay, the break even is 5 plus 1 because that gives you plus 1 on this order and plus 6 on this order. So with cost and everything concerned, that's your cover. So if price starts going up and you get nervous, you can cover this order in the middle until this order clears and then move your stop up to plus 1. When the whole structure clears, you want to get your stop out in front of everything. Okay, it's just simple math. Do the math. If you're trading 20s, right, 0 to 20, stop loss is the midline is 10 plus 1, cover costs, cover the spread. It might be 10 plus 2 depending on your broker. If the spread is 1.1, 1.2, cover at 12. But you need separation. You need price to come in, hit, and get the hell out of here, and then cover at 11 or 12. When price clears the original entry, then you cover the whole structure at +1 for both orders. So then what happens? You're insured the spacing, a win of spacing +1. What the hell do you mean, Steve? Okay, if you space this order out 20, that's a +20 on one order and a +1 on the highest order in the grid. So that's a 21 pip win or 21 tick win in that instance. It depends on you're looking to vary time and price. Why? Because it takes an hour to 3 or 4 hours to build out a W. So you're sitting there trying to find the perfect opportunity to get in on the W, and maybe you're not hitting it correctly. So if you get in with your initial order, you didn't shoot your whole clip of your gun. You have another shot. And over time, as time builds, you're going to become much more diligent playing around with that. It's a really good way to approach the market, especially if you're having any kind of struggle. All right, so second order's triggered. How do you handle limits and stops? Okay, second order's triggered. Adjust your limit order to the initial target minus the second limit value. That's your new limit order for exit. Stop adjust. Adjust the stop to the midline +1 on any grid you build. If it's a 3 grid, 2 grid, 1 grid, adjust your stop to midline +1. That covers the 2 orders. 2 orders will always cancel out 3, and 2 orders will cancel out everything if you go to +1, right? Then again, you cover, right? You cover half the distance +1, and then you cover the whole thing when it's clear. And that's gonna give you a win of the spacing, 10, 20 pips plus 1 extra pip to cover cost. And that's it. It's simple, but it's so powerful because it gives you, it should calm your fears, because you're going to get in something, I'm going to get stopped out, I'm going to get stopped out. Listen, if you find yourself putting an order on, getting in a trade, and then you stop getting near and you slide it down lower, okay, well then you should have sold again or bought again at that level when it hits there and you moved your stop. Your stop should have been here all along, and you should have had an entry and buy or sell the stop level again and have an entry, a cover down here, and then you have a target up here. And the goal is for you to think this is it, picks this order up and goes to target, and you adjusted the target with 2 orders on, and you're in a good place. And I mean, the ADRs have been sick, especially in the pound. So you may not have to adjust your ADR under these market conditions, but the idea is to don't be ridiculously greedy. Take the cycle close where it's supposed to close, because you're going to book 80 pips, right, at $100 a tick or $200 a tick, whatever you're doing in a prop account, and you're going to be able to do this more often than not. And the idea is you're not going to be a 50-50 trader. You're going to be a 90 or an 80 or 90%, or in some cases you'll have 100% weeks where you just picked up the second order and you were killing it, and you're going to have 0 loss. So you can afford to gain a little less because you're not giving it back in the form of a stop level, right? If you take 5 trades and they're all aggregate and all entries get in, then you're going to have 5 wins and 0 losses, right? Okay, well, you have to go back and see how many times the second order, right? The second order triggered. If the second order had only triggered 1 time all week, okay, well then you would have went 4-1. If you can go 4-1 with a 3R, then you don't need this anymore. But if you can't go 4-1, and let's say that both orders triggered 4 out of 4 times, okay, well, you would have been stopped out. You would have been 0 for 4 in the week instead of 4 for 4. You understand, this is going to keep you from this kind of shit happening to you, and that's the kind of stuff that rattles your confidence in the business. All right, don't be like a ridiculous maniac trying to get all your orders on like there's one bar that moves and you're like, oh, sold here, sold here, sold here, and I got a little order over here and my stop's over here. No, the idea is to vary the levels based on how the dealer behaves, right? If he throws a massive spike 50, 60 pips down, you know, most of the time that's a vector end of move vertical market, right? So you could space it out on there, but you need to maintain the distance. But the idea is to never really get in on the same bar. And I'm not talking about 1 hour bars. That's different. There's a lot of variance in a 1 hour bar. I'm talking about 15-minute bars. You could spread the love around a little bit to maybe get a bar here, maybe get an order on here, wait to see something, get an order on there. Make sense? All right. Space is based on pairs traded, stop hunt levels, and your ability to identify these areas. Okay, so if you're trading GA or GJ, you need to spread those orders out, man. You're gonna get smoked trading 5 pips apart. There's no variance there. You're trying to vary the level over price and time. Where's the variance? You need to have a minimum of 1 bar in between, 15-minute bars now. 1 bar and 10 pips. All right. Let me write this down for everybody scoring at home. 1 bar and 10 pips. That's the variance. Stop loss needs to be very important. Okay. This is the variance. I'm just going to call it vary. Stop loss needs to be 2% to a max of 5% of the account balance of both orders cumulatively to the stop. All right, so if this is order 1 and this is order 2, measure this distance and calculate, right? If the orders are evens, right? If it's a 2-lotter and a 2-lotter, okay, 2 times 20 is 40 ticks loss. 2 times 10 is 20 ticks loss. You have to understand that you're going to lose 60 ticks on a bad swing where you just get the market completely wrong and it just keeps pushing lower or higher. So if you understand that 60 ticks, and if you're at $100 a tick, that's going to hurt. If you're at $10 a tick, hurts a little less, right? 600 or 6,000, depending on what you're trading. And I don't know if $6,000 for a hard hit is takes you out of the game over there or how that works. There's got to be some threshold for daily and weekly and overall loss. They can't just allow you to come in there and take their money and get smoked every day. So whatever those numbers are, you figure out a number you can work in the confines of that, and you build a model around that. If you're qualifying for a $100,000 account and the max drawdown's 10, then you need to allow yourself 2 or 3 losing trades, right? So let's talk about that. Let's say the max draw is 10, whatever the number is. Okay, the max draw is $10,000, and then you're out of business. Okay, so then what do you need? You need to know a little bit about yourself. If you're trading an aggregate model entry, how often within a day will you lose? How often a day will you, if the answer is 3, okay, then you need to take $10,000 divided by 4. Well, wait, Steve, I'll only lose 3 times. Exactly. You need an extra chance to get out and get even. So you divide it by 4. That allows you 3 losses and 1 win, right? It actually should look like that, 1 for 3. So that means that your max stop out ability per day is 2,500. I don't know if it's 10,000 or if it's like $9.99 and 99 cents and you hit 10,000, you pack your shit, or if it's, you know what I'm saying? So if it's 1,900 or if it's slightly below 10,000, then you need to make a $2,000 hit or 2,250, right? You have to figure out, calculate it based on that, right? 2,500 would be your max loss, right? Or 2,000 or 1,900, depending on how this works. You can use 2,500 if you got 10,000, but if 10,000 is a hard limit, then make it 2,000. That gives you an extra stab at it, right? 2 times 4 is 8. You'll be $2,000 under the limit, and then maybe you go half size on the last try. So you have some working room. I don't know. You got to figure it out. You got to figure out the amount that allows you to stay in the game. And that's important, because that, if you hit that amount and you're out of business, then what do you got to do? You got to pay and requalify. I don't know how it works. So if you have to pay again, you don't want to do that shit. So allow yourself the number of trades, and you have to know about yourself. You take your past trading record and you go, okay, man, I get 3 stop outs in a row, then I usually bang one out. Okay, so allow yourself 4. What if you get 4 stop outs in a row? Then you just burned yourself. So these 4 trades should come under the max threshold number, whatever it is, right? So it could be, maybe your stop out could be 1900. So you take 1900 and you build your grid, right? 1 order, 2 order, and a stop. You build your grid, stop loss level. You build your grid based on the spacing here, which should be a minimum of 10 pips and a 10 or 20 pip stop, to where you hit 1900 if that whole grid fails. You understand? You're basically building a grid or aggregate over a range of a bar or a bar or two. I mean, on a 1 hour chart, you could space that out. 2 bars would be 60 minutes, right? The first bar fires, you get some time in the middle of the bar, then the next bar closes and you get in on the open or somewhere in the next bar. That's spread out over an hour to an hour and a half to a max of 2 hours, which gives you time, and then you vary the price. Don't do some stupid shit like if you get in, right, and price goes down like a railroad track, and while it's passing down, you get in here, and then it opens back up the other way. When it's on its way up, you get in here, and you're like, damn, I got 0 spacing. That's stupid. No offense. All right, you need to get in at different levels on the bar to allow for the variance on the dealer. If he decides, if you get in on top of each other, you might as well just want all in and all out. You didn't get anything other than time waiting around to get it. You need to get in at least 10 pips apart, right? So if you got in here and the bar closes and it rejects and it looks good, then you can open here. Then you got, as long as the spacing, right, is decent. I'd rather see you get in here, let's say 1 hour chart, you get a set of railroad tracks. I'd rather see you get in mid bar and at the close of the railroad track, because you got something there. That's a full 60-minute rejection, right? All the way down, rejected off the lows and came all the way back up. And especially if this bar here closes slightly above that bar, that means it took out the previous level. Whatever the book took to press that down is gone. Now you got something. You got a higher probability railroad track entry on a 60-minute chart. If you go back and look at 60-minute charts historically, hammers and railroad tracks on 60-minute charts usually lead in the direction of the last closed bar. What? Say that again. All right, one more time. If you look at a 60-minute chart, and I'm just using railroad tracks in this example, if you get a railroad track and it looks something like this, okay, if this is a coming in, going up model, then this is a good entry. You should look for some kind of structure here to get higher price. And if it's doing this, if it's coming down, it usually does that. If you get railroad tracks on a 1 hour chart are pretty strong. You can get a direction where it's going to go 20, 30 pips, half the distance of a bar, a 1 hour bar. It can, of course, it can go back up and it can go back down. But when you get a set of railroad tracks or an evening star formation on a 1 hour chart, it's pretty powerful. You'll get a push in the direction of the rejection area. All right. So the dealer varies the level over time and price. So why aren't you varying the level over time and price? I promise you that this will bring anyone struggling with around a 50% or lower win rate, it'll bring in the 80% plus range. It absolutely will. All right, I am sitting at 4308. I am going to end it with just this model. And when I get back next week and go live with you guys, we will talk about the Bookmap stuff that I had to show you. I had some patterns. I want to show you how they do the blocking and the block zones that I've been talking about for years. It's like almost like amazing to see it play out in the book, and I can't wait to share that with you guys. Hope everyone's doing okay. I missed you live this week. Everything's great on my end. I will see you next Wednesday. Have a great night. Goodbye.